Good afternoon, everybody, and welcome to the bank's inflation report press conference. On my left is Dave Ramsden, the Deputy Governor for Markets and Banking. On my far right is Ben Broadbent, the Deputy Governor for Monetary Policy. And on my immediate right is the Governor, Mark Carney.
Thank you, Gareth. Good afternoon, everyone. Back in February, the MPC observed that the fog of Brexit was creating a series of tensions for UK businesses, households, and financial markets, and that all of this was occurring against a backdrop of considerable trade and financial pressures in the global economy. At that time, the short-term outlook for the UK economy was subdued, and the data was expected to be unusually volatile and potentially less informative than usual. But provided clarity emerged about the future relationship with the EU and the worst of global risks were avoided, the MPC expected that UK growth would pick up to above potential rates, domestic inflationary pressures would build gradually, and a modest ongoing withdrawal of monetary stimulus would be required to keep inflation sustainably at target at the policy horizon. The question is, what has changed since then? Well, from a global perspective, in recent months, global tensions have eased. In particular, there's been a marked easing in global financial conditions, triggered by revisions to monetary policy outlooks in major economies. In tandem, global risk sentiment has recovered, and this has spilled over to lower yields and to ease financial conditions in the United Kingdom. And there have also been signs that global trade is stabilizing, and trade tensions, at least for now, have abated somewhat. Partly as a result, activity appears to be stabilizing in the major economies. The hard data now suggests that global growth troughed towards the end of last year, and the survey data bottomed out shortly thereafter. Recent developments are consistent with the MPC's expectations for a modest pickup in global growth over the course of this year to around potential rates. In contrast to the more benign global backdrop, domestic tensions remain. And to get a sense of their consequences, it's helpful to review how the UK economy has performed relative to the MPC's forecast from February of last year. The headline result has been that growth has been bang on our expectations, but the components have been different. Employment and wage growth have meant consumption was stronger than anticipated, growing by 2% versus 1.5% expected. Offsetting that positive news, business investment fell by more than 2% rather than growing by 4%. And net trade subtracted 0.5% from the expansion instead of contributing 0.75 percentage point to growth. And it's this pattern that looks set to continue in the near term. The latest Business Investment Intentions Survey point to further declines over the next few quarters, and if that happens, that would mark the longest run of falling investment in the post-war era. Falling investment is weighing on productivity growth, boosting unit labor costs, and supporting domestically generated inflation. Unable to plan for their long-term future, UK businesses have focused on short-term Brexit contingency plans. Concerned about disruptions to trade given the potential March 29th cliff edge, companies on both sides of the channel brought forward production, pushing goods imports and exports with the EU to decade highs in the 3 months to February, despite the doldrums in both economies. According to our agent surveys, the proportion of UK firms with contingency plans in place has risen from about a half in February to around 3/4 at present. And stock building has been central to the plans of over 2/5 of those firms, boosting GDP in the first quarter. Nevertheless, it remains that companies are only as ready as they can be, and they expect a marked decline in the rate of growth, investment, and employment in the event of a hard Brexit. In recent surveys, firms expected their output would fall by 3.5% in the event of a no-deal, no-transition Brexit. Faced with the high option value of waiting for news about Brexit, companies in aggregate appear to have favored hiring over capital investment. As a result, the UK labour market has outperformed expectations over the past year, with employment and wage growth both surprising on the upside. The resulting strength in real income growth has supported consumption, which in turn has driven domestic demand. Four-quarter real income growth picked up further in the first quarter, and surveys of consumer confidence indicate that households remain relatively optimistic about their own personal financial prospects, despite being pessimistic about the overall economic situation. And that divergence may be one reason why the only area of household spending that is discernibly restrained by Brexit is the housing market, where transactions are currently somewhat subdued and prices are stagnating. In aggregate, first quarter growth is projected to come in 0.3 percentage points stronger than we had projected in the February inflation report. About half of that upside surprise could be due to the boost from Brexit-related stock building. Consistent with reports from our agents, the MPC expects a corresponding drag in the second quarter. Smoothing through this volatility, the underlying pace of growth is a touch stronger than the MPC had previously assessed, though it's still a little below potential, meaning that the current margin of slack in the economy is expected to widen a little in coming quarters. While financial markets remain sensitive to Brexit-related news, global developments appear to have driven the market curve for bank rate that underlies the MPC's projections. Expectations of policy rates in the United States and the euro area have fallen significantly since February, and market expectations for the path of bank rate have followed. That path currently implies that bank rate will rise to around 1% by the end of the forecast period, around 15 basis points lower than in the February report. As the MPC's inflation forecast suggests, this new market curve introduces an additional financial market tension to the one that already exists between the current level of sterling and the level that would be consistent with whatever Brexit outcome ultimately comes to pass. Now, at some point, the tensions between households, corporates, and financial markets will be reconciled. And in the MPC's projection, that resolution comes through our assumption of a smooth Brexit to an average outcome, resulting in a forecast that has two phases. In the first phase, and the first phase covers the balance of this year, growth remains modest, reflecting the continued drag from Brexit uncertainties and below potential global growth. And near-term inflation is expected to pop up above 2% in April, but then fall back below target, in large part reflecting moves in household energy prices and the still modest core services inflation. In the second phase, so over the balance of the forecast beyond 2019, as global growth stabilizes around potential rates and Brexit uncertainties wane, business investment growth recovers, the housing market improves, consumption continues to grow broadly in line with incomes, and aggregate demand picks up to above potential rates. Excess demand rises to slightly above 1% by the end of the forecast period, notably higher than in February, with the unemployment rate projected to decline to 3.5%. The emergence of excess demand leads to a strengthening of domestic inflationary pressures, more than offsetting the fading contribution from imports and energy prices, such that inflation rises above target in 2 years' time and continues rising through the end of the forecast period. At its meeting yesterday, the MPC agreed that the current stance of policy remains appropriate. We emphasized that the right path for monetary policy will depend on how those tensions between businesses, households, and financial markets are resolved, and the response of monetary policy to Brexit will depend on the balance of its effects on supply, demand, and the exchange rate. But the MPC's latest projections imply that the current market curve, used as a conditioning assumption for our forecast, is unequal to the task of meeting the MPC's remit. Based on the MPC's conditioning assumption of a smooth Brexit, the committee continues to judge that an ongoing tightening of monetary policy over the forecast period at a gradual pace and to a limited extent would be appropriate to return inflation sustainably to the 2% target at a conventional horizon. And with that, Dave and Ben and I would be pleased to take your questions.
Okay, as always, please make sure you give us your name and the organisation you represent, and please stick to one question each for the first go round. We'll lead off with Darshini and then Jemana to begin.
Thank you. Governor, given the forecast you've outlined today with a fair degree of excess demand by the end of the forecast period, inflation rising above target, in normal circumstances, we might have expected a policy tightening today. Given that's not happening, assuming there's a smooth Brexit, what can we read into the pace of gradual and limited interest rate rises further down the road? Could you shed some light on what that might look like in practice?
Well, I think the way we would put it, Darshini, is that if something broadly like this forecast comes to pass, so a period of time where the economy is growing, not quite at potential, but growing, and these domestic inflationary pressures are continuing to build, even though we're going through this period of uncertainty in the run-up to some resolution around Brexit. But then that resolution is some form of arrangement with some form of relatively smooth transition to it. It will require interest rate increases over that period, and it will require more and more frequent interest rate increases than the market currently expects. Now, I think I'll finish with this, which is that there are a lot of factors that affect sometimes yields in markets, and those include global developments and some risk premia that can be put in because of major structural events about which there's uncertainty, and of course, those are many words to refer to things like Brexit. Thank you.
So to be absolutely crystal clear, we're talking about a faster pace than
We're still, what we're talking about is more withdrawal of monetary stimulus. In other words, cumulatively more hikes, but still a limited amount relative to history and at a gradual pace.
Okay, Jemana at the back, and then Lucy.
Joanna Bersacci from CNBC. Just to pick up on that point, so in paragraph 3 of the minutes, you say the MPC judges that there's a small margin of excess supply in the economy right now. So putting the two together and the question that was just asked, are you therefore guiding the market towards more backloaded interest rate hikes and ruling out the possibility of doing something imminently?
I think to the extent, Jemana, that there's guidance, it's that there's insufficient hikes in the current market curve to be consistent with our remit. To be absolutely clear, our remit is 2% CPI inflation, as you know. We talk about moving or returning inflation to target over a conventional horizon. Conventionally, the horizon over which monetary policy has the most traction is 18 to 24 months. We have inflation above target at that point, and then rising further off and continuing, I might add, off stage, if you will, beyond the forecast horizon. So there is it will be appropriate, or would be appropriate, I'll put it in the conditional, because it's conditional on something like the forecast transpiring, and there's some big conditioning assumptions in that. But if the world unfolds broadly as consistent with this forecast, then it will require a greater withdrawal of monetary stimulus than is currently implied. It just didn't require it at this meeting.
Okay, Lucy, and then Adam on the right.
Thanks. Lucy Meakin from Bloomberg. Could you explain the justification for keeping the conditioning assumptions as they are, given they potentially don't really acknowledge the reality of the Brexit process so far? I think a lot of people would look at the premise of a smooth Brexit and see a disconnect with what they're seeing in Parliament and the extension.
Well, I'm not sure I fully agree. I think what we have seen is that Parliament has voted, and voted explicitly, against a no-deal Brexit. So if you take no-deal Brexit as an example of something which is not a smooth transition to whatever form Brexit takes, so Parliament has expressed a clear opinion on that, as have, including the United Kingdom, the 28 countries of the European Union, which is why there have been extensions to the process. So everyone knows that the process is not concluded, that what remains to be agreed is both the nature of the withdrawal and the broad outlines of the end state. But when decision makers, and the decision makers here are parliaments and the leaders of the European Union, when those decision makers have had the option to make those decisions, they've consistently expressed a preference or have taken decisions that are consistent with a smooth transition. Now, we don't know, you don't know, companies in the United Kingdom and Europe and around the world for that matter, investors don't know what that transition, exactly the form it will take, and where it's headed. And when you bring that back to what the impact that is having on the UK economy, it's principally expressed, quite starkly expressed, through business decisions, business investment decisions. It's a very unusual situation to be in an expansion and have investment falling. There's been quite substantial contingency plans put in place and moves consistent with that. And consequence of all of that is, as we cautioned in February and we're re-emphasizing today, is that in the short term we're going to have a fair bit of volatility both in the hard and soft data. We're trying to look through that, see where the underlying economy is going, and based on that assumption, which is still the base case, smooth transition to some form of deal, what would be, where the economy would go and therefore what the consequences are for policy.
Okay, so Adam at the back and then Alex.
Governor, the trend of businesses or UK businesses cutting investment but also spending their money on employing people seems like a familiar one, because I think we heard that after the financial crisis, which in a lot of people's estimation led to lower productivity than our European rivals. Do you think we are on that path again, and could that trend exacerbate the productivity problem that we have in this country? Okay,
well, why don't I start and then I'll hand to Ben. I'll say a couple of things. One, following the financial crisis, I mean, I agree with the high-level premise of your question. There are some similarities here, but there are also some differences. And following the financial crisis, one of the differences was a fairly substantial positive labor supply shock, if I can put it in economic jargon. I'll start on that and try and, by which we mean that there were a series of factors which increased proportion of the population that was remained in the labor force or came into the labor force. Some of those factors were pretty difficult for households: overhang of debt, savings for retirement, which had been hit by the financial crisis, so they just needed to stay longer. Other factors were changes to welfare and other policies, which kept people in. Other positive factors in terms of education, et cetera. But positive labor supply shock, and that partly affected things. Post the financial crisis, and particularly affected things in the early stages of the recovery and the expansion. What we're seeing now, and I want to hand to Ben with this, is that, in our judgment, there's evidence that the uncertainty around Brexit is effectively raising the hurdle rate for business investment. And so the relative cost of investment versus hiring has shifted quite substantially in favor of hiring. And the consequence of that is what's happened short-term to business investment, what's happened to the hiring, and it will have some implications, as you say, for productivity. But Ben.
Yeah, no, I think that's exactly the point, and there is the parallel with after the financial crisis. Although arguably the cause of the high cost of financing investment was different then, it was that the banks were starving firms of credit. Now it's not so much to do with finance, but to do with this uncertainty. But it has exactly the same effects on the investment, on the incentives to invest, i.e. to depress them, and for any given level of activity, firms would prefer to employ people instead. And indeed, when things get really uncertain, even within employment, they prefer to employ temporary employees rather than permanent ones for similar reasons. When you look at the numbers, clearly it can have an effect on productivity. Equally, it's not going to give you a big contribution to the so-called productivity puzzle. It's not enough to explain why productivity growth here and elsewhere, for that matter, has been so much lower than before the crisis, but it's definitely a contributory factor. And you're right, directionally, that will be the effect of this continued for a long time.
Alex at the front, and then Joel.
Alex from the Daily Mail. Governor, you painted a picture of two economies, really. The first economy, a kind of quite confident or more confident consumer economy where people actually are going out and spending and running up bills on their credit cards and so on, and doing all of that. And on the second hand, a bunch of moaning minis in business who are refusing to invest in real things as opposed to invest in people rather than plant and machinery. Is there some way that the bank and the business groups who represent business can encourage investment rather than just moaning about it, the lack of it?
Yeah. Okay. So just, if I may, just make one comment on the household side, which is that households are spending. They're not running up their credit card debt. This is not a debt-fueled consumption boom. What's happening to households is that in aggregate, wage growth has been picking up, something we've been expecting for some time. It's actually picked up a little more than we had expected, but broad brush, what we've been expecting. But then employment has also been stronger. So in aggregate, real wage income or real income is stronger, and that's what's driving consumption. And I think, as you've seen in the most recent credit numbers coming out and credit condition survey coming out of the bank, is that actual credit growth, the rate of credit growth has continued to decline. It's still growing, but it's continued to decline. In terms of business, I wouldn't use the term that you used. I don't think businesses are. I think and we talk to a lot of businesses. I'm sure you do, but we do it sort of systematically up and down the country. And many businesses are faced with a very fundamental question of what type of market access they're going to have. And in many cases, it's access to suppliers for their business, for their products or services, which are sold either here or in third countries, or it could be directly for export markets. And it's entirely understandable when there is a very wide range of potential deals and potential transition periods to that. On average, they do expect something similar to our conditioning assumption, to go back to the question a moment ago. On average, they expect that. But they also expect, and there's increasing evidence through our decision-maker panel, that they don't expect this to be resolved for some time. And more and more of them, you recall, a substantial proportion, cross-referenced in the report, don't expect resolution by the end of this year. And so in that environment, it is difficult to make those longer-term investment decisions. If I were to characterize them, I wouldn't characterize them as using the M word that you used. I would characterize them as very eager to get on with investing and building their businesses. Yeah.
Okay, so Joel at the back, and then Chris.
Governor, most of the members of the Monetary Policy Committee are men. The Bank of England has diversity targets. It's not clear you're going to hit them. As of today, Britain has its first female defence minister. Should the governor of the Bank of England, the next one, be a woman?
So what we, as representatives, senior management of the bank, can control is the mix, both in terms of gender, ethnic diversity, cognitive diversity, socioeconomic diversity, those elements of diversity in the Bank of England. And we have been taking very deliberate, comprehensive steps over the course of the last 5 years to shift those. I don't agree with your characterization in terms of our targets. Senior management, women's senior management was 17% in 2013, 31% today. We're on track for a 35% objective. The pipeline is very strong. We're just under 50% below senior management. Same in terms of our hiring. We're making big progress in the intake, graduate intake, and others, and hiring intake in terms of BAME and other characteristics. So what we can influence, we are, and we're making progress, and that is more than just who you bring in, but it's how you work and how you act and how you develop. So we're we're shifting the dial on that without question. The decision of who is my successor, who's on the MPC, the FPC, the PRC, the court of the Bank of England, those are decisions for the government. And so questions about who it will be and the characteristics of who it will be for any of those roles are really questions for the government.
Chris Giles from the Financial Times. Governor, we've got a forecast here which has got a very large degree of excess demand by the end of the period, and yet inflation running at only 2.16% in your mode forecast, which is lower than the Bank of England has achieved over the past 10 years on average. So it's not a high rate of inflation. Does this mean that we should actually be a little bit more relaxed about the forecast and maybe not worry so much about the excess demand that you have been predicting?
No. It maybe won't surprise you that there's never really a time to characterize the MPC as relaxed, and now is not one of them. I'll admit that that's one of the job characteristics that one would look for, is not being relaxed, preternaturally relaxed maybe. There's a couple of things that are going on in this forecast that are important to see. One is that there is steadily building domestic inflationary pressures over the course of it. Secondly, that whether it's 2.1 or 2.2, and particularly when it's 2.1 at year 2 and 2.2 at year 3 and rising off stage, that's not target consistent or remit consistent inflation, particularly again when the economy is in a position of considerable excess demand. So as you well know, we stretched the flexibility of our remit post-referendum because we felt there was substantial slack in the economy and the issue was trading off jobs for inflation. It's a different world where you're moving to, on some measures, the joint lowest unemployment rate on measured time. I think 73, it was the last time we would have been at 3.5%, but not with an employment share that's similar to this. So not consistent with the remit, inflation building, but there's also reasons why inflation isn't even higher, and there's slightly situation specific. So your question is very welcome, and I'm actually going to ask Ben to, if I could, to sort of expand on some of those.
So one point to make with reference to what the Governor just said about off stage is that we don't actually move into balance and then excess demand for another year or so in this forecast. And given the lags between what happens to slack in the economy and what happens to inflation, you quoted the figure of excess demand at the end forecast. That would be having its effect on inflation beyond the forecast period. The second point to make is there's still a forecast, like we've had for the last 2 or 3 years, when import price pass-through, at least by the end, is fading, and that's pulling down on inflation independently of what's happening to domestic cost pressure. And then the third point to make, and this is a little fiddly, but it matters. As you know, we base our forecasts on the market price for oil in the forward markets for oil. And that is downward sloping, unusually slow at the moment. Whereas the forward price in the market is cheaper than the current spot price of oil, and that imparts a negative effect on petrol prices. And more generally, if you look at energy prices overall, their contribution to inflation is close to 0.2 percentage points lower than normal. So there's a lot of other stuff going on that affects inflation other than just what's happening to excess demand. If you took those away, I think you'd see the impact of that excess demand on inflation more clearly, particularly if you move beyond the 3-year forecast.
So just, and let me just pick up on that last point and reinforce it, which is you have an oil curve which is in backwardation. I just wanted to say that once. I just wanted to use the term backwardation. Yeah, it was there for you, and you didn't use it. But you have an oil curve which is downward sloping. So we all know that oil prices have gone up quite substantially in the last several weeks. So it's kind of curious that oil is dragging on inflation further out, but it's because, at least in the market's judgment, it's expected to fall off 3 years from now, and that has a material drag. So think, just to translate what Ben just said, if inflation at year 3 were 2.4 instead of 2.2, which is what would happen if the curve just stayed at the spot. at the spot level. There's a bit of stuff in domestic energy prices as well, off-gem cap issues as well. I'm happy to discuss it in more detail if you want. Now, that, of course, may not transpire. We're not making a prediction about the price of oil. We just take the market curve and use it as an assumption. The one thing you know is that the oil price is going to move around, and that curve is going to move around between now and then. And so when we're looking at it, and future MPCs are looking at this, if this forecast rolls forward, they'll be looking and concentrating not so much on where commodity prices are on a spot basis a year ahead, but where underlying, as you know, domestic inflationary pressures. And they certainly are building in a way, at least we would expect them to build in a way that's consistent with that excess demand pressure. And it's that adjustment, and it's not being relaxed about that, if I can go back to where we started, that helps keep inflation on target.
Okay, Phil, and then Larry.
Phil Aldrich at The Times. There's been a lot of talk about the customs arrangement in Brexit discussions lately. And I just wondered if you could tell us where a customs agreement would, or a customs arrangement would sit in relation to your central forecast for Brexit. Are there implications for growth? And also, does the bank, with your financial stability hat on, actually would you welcome a customs arrangement because it would not impinge on your ability to be a rule maker in the city?
Okay, so two questions. First, in terms of customs union, and as you know, I think we all know that there are customs unions, and these terms mean different things. Sometimes it could be a customs union and not even be called a customs union, or it could be called a customs union, could be less than something. So to some extent, the devil's in the detail. But in the spirit of the question, just to be clear, about, as clear as we can be about our conditioning assumption, which has been with all of us for some time, is we're using an average between WTO and a EEA-style deal, so a Norway-type deal. And that average sits somewhere between a free trade agreement and a form of customs union. So and what follows from that is a customs union that had an external, common external tariffs and a degree of, high degree of alignment of product markets would be slightly better in terms of the degree of integration. I'm not making a broader normative judgment about the desire, but in terms of the degree of integration, it would be a higher degree of integration than the base conditioning assumption here. Of course, if there were an agreement and there were clarity on transition to it, at that point, whatever agreement happens, and certainly if no agreement happens, the MPC at the time is going to have to roll up its sleeves and recast its forecast as a consequence. But broad brush, slightly more integration, which would imply in the short term, again, this isn't a long-term judgment, in the short term, slightly higher growth, slightly higher investment growth, and likely inflationary pressures, although I'll leave that to the forecast at the time, decision at the time. In terms of, to look at it from a financial stability perspective, and maybe I'm going to broaden it slightly more, which is to say the government, ultimately Parliament, have to make some very a series of very large trade-offs in crafting any arrangement with the EU 27. One of the considerations is the degree of financial services access, and one of the considerations for that is the potential impact on financial stability of being, to use the term you used, of being a rule taker, if there was a form of equivalence which ended up being a rule taker. So that's one of many considerations that have to be taken into account. If you narrow it down to the specific consideration, is it better for UK financial stability that not just the Bank of England, but the FCA and the Treasury have an ability to set rules in a way that's commensurate with the world's largest and most complex financial system? The answer is yes. But those are trade-offs that are made in a much bigger context. And after all, trade-offs as well that are made as part of a negotiation. So we wouldn't pretend, other than making that observation, we wouldn't pretend to give any advice on the overall end state.
Okay, Larry and then Tim next door.
Larry Elliott of The Guardian. Climate change has been much in the news lately, and you've added to that a debate by warning companies about the risks of not changing their business models. I just wonder whether you think it's enough for climate change just to be dealt with by the bank's financial policy committee, or whether, if climate change is as serious a threat as you say it is, it should also be a matter for the monetary policy committee too, to assess when it's coming to its judgments.
I didn't catch the last bit, sorry, to assess.
Whether the MPC should also be considering the impact of climate change when it's making its judgments about interest rates.
Well, let's take the first bit in terms of what the FPC has done, I mean, take note that Parliament declared a climate emergency yesterday, as did the Scottish Authority, Scottish Assembly a few weeks previous. And in many respects, that reinforces the approach that the FPC has taken. The issues ultimately for addressing climate change are questions of government policy, broader public policy, and the responsibility of the bank and of private financial institutions is to be ready for those, to have strategies that are resilient to not just the physical risks of climate change, but at least over the course of the next several years, for most financial institutions, the bigger issues will be changes in the policy framework. So to the extent to which climate change is, or the policies to address climate change are tightened, if I can use that terminology, those institutions should be, and the institutions they fund should be disclosing their exposure to it, their strategies to it, how they manage those risks, how they're going to seize the opportunities, and particularly for financial institutions and the ones that we regulate, they should know how to manage the risks, those types of risks, and that's why the bank put out concluded a supervisory statement for banks and insurers, and released it 2 weeks ago. It's why we're looking at scenario analysis and stress testing and a variety of other issues. Okay. So that's the bigger context, and I would say that events of the last several weeks reinforce the importance of that flexibility and that being ready and being able to adjust and thinking about where policy is going as much as where the climate is going. I mean, obviously the climate is important, but not everybody is exposed on the horizon they have. And this issue of horizon brings me to monetary policy. So for us, I mean, we spend a lot of time, and most of the questions have been understandably focused on what's going to happen in the next few quarters and the next few years. And the climate issues are relevant from a monetary policy perspective to the extent they impact the forecast, the path of the economy and inflationary pressures over the course of the next few years. And, you know, I mean, this was a point I tried to make a few years ago and reinforce, which is, you know, the tragedy of the horizon is that if you rely on when it becomes relevant for monetary policy, it will be too late. That's not to detract at all from the steps that the bank, through the FPC and other, and through the PRA, is taking to make sure the system is not just ready to address these issues, but is actively managing these issues. And I'll finish with this. Actively managing means not just managing the risks, but actually funding and seizing the opportunities associated with the transition to a low-carbon economy. And this is an area, you know, we spend a lot of time, understandably, talking about shorter-term issues around Brexit and adjustment, but this is an area where the UK really does lead, and the city does lead, and can extend that leadership and its impact globally.
Tim and then Francine.
Tim Wallace at The Telegraph. Governor, there's an interesting box in the inflation report on the mortgage market. It says it's a very competitive market, so not all of the rises in base rate have been passed on to borrowers in recent years. Also, we know that lots of borrowers have got fixed rate terms, so they're locked into their current price. As and when the time comes to tighten policy, will interest rates lack power to do what you hope to inflation, given not all of these rates will be passed on, and they might be passed on more slowly.
Well, let me. In the past. It's an important question. Let me start with the headline and then pass to Dave to talk a bit about what's going on in terms of the transmission of monetary policy. So the headline is that what we need to do as a committee is keep not rely on old models of historic relationships between bank rate and what happens to mortgage rates or other borrowing rates and therefore the economy, but what's happening at present. This is something that's not emphasized in the box, but I'll make it and then pass to Dave. One of the big things that shifted, as people would know, is that this used to be almost exclusively a floating rate mortgage market. It's moved to predominantly a fixed rate mortgage market. A lot of it over the time I've been here, I didn't have anything to do with it, but that's what's happened. And that in and of itself changes some of the transmission. You don't get you get less of an immediate impact on transition. But as you know, Tim, but I'd like Dave to expand for a bit, is what's highlighted in the box is the shift in funding patterns for the banks and the impact that's having on the transmission of policy, because this is an important point, which is why we've tried to highlight it.
And just to pick up from where the Governor left it, I mean, what we've been really flagging, we did this in the February inflation report, and we come back to it here, is that wholesale funding is diminishing as a source of funding. Much more reliance on deposit funding. That share has been rising, and particularly on sight deposits. And we're actually at the point where the value of banks' deposits now exceeds that of their loans. We've had that crossover. So there really has been a pretty significant change in funding patterns. We were talking earlier about impacts since the crisis. That's been playing out over time, but we've really been highlighting it. But in terms of the transmission mechanism for policy, that remains similar to where it has been in recent years. We don't think that there's been a very significant change in the potency of policy.
Nancy? Sorry, at the back here in the second row.
Thank you. Governor, in the notes it basically says short-term economic data may be providing less of a signal than usual about the medium-term growth outlook. How should markets interpret it? Are you less data dependent than previously?
Well, I think we, the market, has to look through the reasons for certain data, and let me give you two examples. So. One of the experiences post-referendum, and which seems to be repeating itself in the present circumstance, is when we get into situations of extreme uncertainty or highly elevated uncertainty. Maybe it's best we can have more uncertainty than this, but we're highly elevated uncertainty. We have the surveys, and particularly the forward-looking surveys. So if you think of the SIP surveys, other surveys, including some of our agent surveys. They tend to overpredict. They have tended to be a bit too pessimistic. So we have aimed off those surveys. For example, the surveys, Ben, help me out. In the first quarter, I think they would have predicted about 0.2 growth. Yeah, we've got 0.5. Current surveys are tracking no growth in the second quarter. We're at 0.2. And that 0.2 itself, which brings me to my second point, is influenced by another form of volatility. So first thing is around some of the usual relationships between the surveys and what actually happens in the economy are less tight than they were previously, first thing. Second is that we had expected some volatility because of inventories, the stock building effect. We didn't anticipate, sort of full disclosure here, what we thought was that we'd focus mainly on the stocks, the domestic stock building would largely be imported, and therefore it was probably going to be more of a wash for GDP. We underestimated two things. One, candidly, just the scale of stock building in Europe. On the other side, So we had a big export, 10-year high in exports, despite the fact that Europe was basically stagnating at the time, and a lot of that appears to be built by stocks or reflect stock building there. And then also, secondly, domestically, there was some, the distribution sector. You have to find a warehouse, you have to get the stocks in place, and that seems to have had an effect as well. So that's fault. But the reason we made the observation before is we didn't think we would get it, this one right. It's a pretty large move, and it's a pretty unusual circumstance. We also didn't think that it really mattered in terms of the inflation, the underlying forecast and monetary policy. So we're signaling those two things in the short term. Now, that said, for what it's worth, as we sit here today, aiming a bit off the surveys, so a little stronger than the surveys, we're saying 0.2 for the second quarter, recognizing that we think there's going to be a give back from stocks. And to be kind of brutally technical, the thing about inventory builds or stock builds, it's the pace at which it builds. It's the second derivative, so it has to, even if it builds at the same rate, you don't get a contribution. And if it builds at a slightly lower rate, it's a drag. And it's a real drag if you actually run down those stocks. So anyway, so we think that there's going to be a give back there. If it were the case that the economy were notably stronger in the second quarter, that might be news. It's not that everything is irrelevant. It's just that you have to really look through the underlying data and make the judgments about that. So.
Okay, on the right here and then just behind.
Gurpreet now on the Times.
Okay.
Your business surveys indicated that the proportion of firms that have contingency plans for Brexit has risen, but a quarter nevertheless said that they don't have any plans in place. Many of them small firms who may be reluctant to commit resources to preparing for scenarios that may or may not arise. Is it really the case that firms are as ready as they can be, or should they be taking advantage of the long extension to getting more ready?
Well, there's a number of firms that have been in that position of being as ready as can be, 6 months prior to March 29th and more. So they had time, but there's limits to what they can do about the economics of an extreme outcome, a no deal, no transition Brexit. I mean, if you source your key components from Europe and you're not going to be able to do that because the trading relationship ends, you're as ready as you can be, but you think, and what the firms are telling us is on average, they think that their output will go down by about 3.5%. Now, that's not true for every firm, but for some firms, it's quite a substantial factor. So you are getting that. So what I would say is, not just from the agent survey, but supplemented from the conversations that we have when we go around the country, is that there are some firms that do feel, they've done everything and they feel ready. There are some firms who are quite confident that they are unaffected and have thought about it. And then there are these other camps which are quite substantial, some who are small, who don't have the resources or a sense of what they can do, and they're hoping for the best. And then others who've done everything they can but think it's going to hurt. And that's the spread. Now, business people will continue to look at this and try to get in a better position for contingencies. But
the only other thing I'd add, and this is relevant for the small firms, is that some of these preparations are quite expensive, and they haven't got the financial space to do them. And even building the stocks that we saw in the first quarter is expensive. It eats up working capital. So there are limits both to what they can do, but as the governor says, even having done everything they can, that doesn't insulate the firms or indeed the economy from the more extreme Brexit outcomes.
Okay, just about that.
Do you think, Governor, that financial markets have become a little complacent about the risks of a no-deal Brexit? They're certainly pricing in a much lower chance of a no-deal Brexit than they were a few months ago. Is there some complacency there, do you think?
Well, I mean, we don't know we know the preferences, the express preferences of Parliament as it stands, the express preferences of, as I said earlier, of the EU 27 leaders in terms of the decisions that have been taken, express preferences of the government for a deal, some form of deal. So we know all of that. But we also know that no deal is the default outcome still on the legislation. And we know that at times, in the run-up to March 29th, the probability of no deal was, notable. It was quite significant. The process is not yet concluded, and until it's concluded, there will be a chance of no deal. Now, markets are paid to make those assessments, and they will, but it is still there as I say, as the default option.
Okay, at the front here, and then Philip behind.
So Hans van Leeuwen from the Australian Financial Review. The point that you've currently landed at on monetary policy, would you say it's broadly aligned or consistent with the place that the Fed and the ECB are at now? Is there a consistency across the North Atlantic institutions?
No. I would say we're in quite a different position. I mean, look, every economy, every central bank, every family, I guess, is unique. But we're in a unique position in the sense of there's this very large issue, which we've spent most of the morning or the afternoon talking about, probably spent most of the morning talking about as well, that is affecting the economy in quite a significant way. How it's resolved will have a material impact on the outlook and therefore on monetary policy. And maybe I'll just finish and make a reference, which is that two points. One is that there tends to be, historically, there has been a relatively tight correlation between the path of U.S. interest rates, Fed policy, and Bank of England policy. It's not lockstep, but it's relatively high degree of correlation, 0.8, 0.9, depending on what 0.85 probably. And that hasn't held in this cycle. And probably think of a pretty good reason why that has been the case. To put it, and then my second point, I'll finish with this, which is to put it within a framework consistent with the framework we put out last year on the neutral rate of interest, so-called R-star, is that we distinguish between sort of medium-term R-star and the R-star, the neutral rate of interest that's relevant at a point in time. And one of the adjustments one would make is a degree of risk premium or uncertainty. So to be absolutely clear, we think the level consistent with the economy operating at potential inflation remaining at target is lower than it otherwise would be because of the degree of uncertainty. As that uncertainty goes away, as that goes away, that means that the neutral rate, the effective relevant neutral rate in this economy, in our judgment, and it is the committee's judgment, would go up, and that would have consequences for policy. Now, that is not something that is facing, to my knowledge at least, either the Fed or the ECB.
Yeah, Philip.
Hi, Philip Inman from The Guardian. I was interested in your remarks earlier about consumer spending and the impact it's had. Could you tell us where your forecast would be without the rise in consumption above your previous forecast? And would you also agree that without tougher welfare rules forcing people into work and the still high levels of immigration, the economy would be pretty well flat?
Ben, how'd you like to take both of those? I mean, it's hard to do the first one because you're taking consumption away without adding anything, but what you could do, is I'll answer the first bit, and you can do you can do the difficult bit. What's given in the first bit, we do a forecast decomposition, which is relative to our February forecast. I think I said in my opening remarks, one of the things, and I'm just going to repeat this because I'm enjoying this, our forecast was bang in line. Okay, GDP grew by as much as we expected in February 2018 to now. Right? But the components were different, and it goes to your question, which is it was consumption, not consumption plus investment and trade, that delivered that. And you can go back into that. I think it's about 0.75 percentage point difference in terms of the degree of consumption. So you would subtract that off, all things being equal, in terms of contribution to growth space. And we'd end up having opened up much more space in terms of the output gap and have lower inflation if consumers had not had the circumstances that they did have. Now, they didn't. They had more strength. But
no, I was going to answer it exactly that way, which is that you have to be very careful about these single things, taking them in isolation without thinking about what would happen overall. And if one particular bit of demand were weaker, then it's likely that policy would have been different. We wouldn't have put up interest rates twice. So we aim to keep the economy growing in line with its potential. Pretty much done that over the last couple of years. And if any particular bit of demand had been either stronger or weaker, then the path of interest rates over the past would have been weaker, and we would still, one hopes, have succeeded in keeping the aggregate close. So you might have asked the question a couple of years ago, for example, or indeed last year. Well, look, you forecast business investment's going to grow by 4%. As we know, it didn't. It actually declined. We think we can identify the reason for that. And it would have therefore contributed quite a bit less to aggregate demand. But aggregate demand nonetheless grew in line with our forecasts. And if it had done, if we had the same wage growth, then maybe interest rates would have been higher. Had business investment and consumption grown in line. So one has to be careful about plucking these things out and then assuming that nothing else changes.
Okay. At the front here and then Adam at the back.
Thank you. Sho Wakagawa, Japanese Nikkei. As you know, Japanese company and financial institutions are very cautious about the outcome and development of the Brexit because a lot of the Japanese company have a European headquarters here in London. So what do you want to address in Japan? I mean, next week in the coming G20 meeting would be held in Japan, or what do you want to send a message there?
Well, I'm not sure which meeting is next week, G20. I know we're going next month. Yeah, next month. Thank you. Yes. One of the very important issues that the Japanese presidency has put on the table has been market fragmentation, particularly financial market fragmentation, but I think it holds for broader fragmentation of risks of fragmentation in the global economy. So we have worked with that presidency and continue to work also in the G7 to address some of the issues that could cause that fragmentation. One of the most basic is, goes back to a question earlier from Phil Aldrich, which is about the level of financial market regulation. We've all worked very hard, the Japanese, ourselves, others, have worked hard to raise the standard of global financial market regulation through the G20. And now that we have achieved that standard, we need to observe and make sure others retain it. But also it means that we can keep our markets open to each other to the benefit of our citizens and do so in a responsible way. So that's a big element of that. The second point that we have emphasized on a number of occasions, and it's a related point, which is that the issues around global trade imbalances are not going to be solved by new agreements on goods. They might be helpful to have agreements on goods, but in terms of orders of magnitude, they will not materially move the needle on the scale of global trade imbalances because those countries with the largest deficits have a much stronger comparative advantage in the service sector than they do in the goods sector. And the United States is the classic example of this. The United Kingdom falls into this camp as well. And so what's particularly important, not just to reduce fragmentation, but to grow global trade and have more inclusive growth, is to make progress on freer trade in services. Thank you.
And final question at the back.
Adam Linton, Ranscork. So earlier you did say that if forecasts are right, then more hikes could potentially be needed than are currently in the curve. Since the Prime meeting, we've seen an extension to the Brexit deadline to potentially October 31st. How would you square that comment with that deadline? Is there an opportunity possibly to hike before that deadline? And if so, what green light would you potentially need to get the go-ahead to deliver that hike? Or would you rather wait until October 31st, hopefully we have a deal, and then proceed thereafter?
No, I think way to answer that is this, which is that if the economy broadly grows consistent with this forecast, performs consistent with this forecast, then this ongoing withdrawal of monetary stimulus at a limited and gradual pace is required to bring inflation sustainably to target and keep it there. That's what sustainably means. Part of the economy evolving consistent with the forecast is development still being consistent with, doesn't have to deliver, but being consistent with this core conditioning assumption of a smooth transition to a form of Brexit arrangement, which is something around the average. So, and I'll leave it at that. Thank you.
Okay, that concludes the press conference. Thank you very much for coming, everybody.
Thank you.